Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Thursday. Well, let's take a look at what's going on more broadly globally in the macro front. US Treasury yields a little changed on weaker than expected US economic growth and labour market data. US GDP increasing at a 2.1% annualised pace in the last quarter, revised lower from the 2.4% growth rate reported last month. But momentum appears to have picked up early in the third quarter as a tight labour market underpins consumer spending. However, the economy is still expanding at a pace above what the Fed regards as non-inflationary growth at around 1.8%. On the jobs front, US private payrolls increasing by less than expected 177,000 jobs last month. Now, elsewhere in terms of data, some important data coming to us from China today. Business activity expected to have moderated further in August. That's according to forecasts for the Chinese PMI survey. Economists seeing manufacturing PMI remaining in contractionary territory and falling to 49.1, while the services PMI is tipped to have remained in expansion, but growing at a slower pace of 51.3. And that data will likely confirm persistent sluggishness in China's economy as the country battles weak consumer confidence amid major deleveraging of its property sector. Investors remaining on the outlook for a greater stimulus from the central government. Well, what are the likely returns over the next decade for a wide range of public and private assets? Well, BCA Research has just released its return assumptions report. And Garry Evans, Chief Global Asset Allocation Strategist at BCA, talked us through it.
We just produced a big report looking at the outlook for returns over the next 10 years. So what are you like to make out of global equities, Australian bonds, etc., on that 10-year time horizon. So to be honest, in that, we don't really take into account the immediate macro horizon. And we deliberately choose 10 years because we're trying in this report not to make a call over where we are in the cycle, are we going to have a recession, etc. We, of course, think about that all the time at BCA Research. But the point of this report is to give long-term investors like superannuation funds, wealth managers, some ideas of the practical likelihood of the type of returns they'll make from different asset classes in the long run.
All right, well, let's break this down perhaps regionally then. When you look, so you've covered the US, or North America with Canada, Australia and emerging markets. What are any sort of particular differences there?
Yeah, so the overall headline result is that for a typical portfolio, 60% equities, 40% bonds, it's going to be a bit better than the outlook was a year ago. So that portfolio, 60 equities, 40 bonds, we would project giving you an annual return of about 4.6%, which isn't bad. It's a bit better than last year, but it's down a bit from the 6.1% that we've had on average over the last 20 years. When you break it down by country, Australia actually comes out looking relatively good, and partly because bond yields are high compared to, for example, Europe or Japan. So for Australian government bonds, we'd be projecting a bit over 4% annual returns. And Australian equities are relatively cheaply valued as well. So for them, we're talking about 7% annual return, which is not far below the long run average of 8.8%. There are one or two other countries that look a bit better. The UK, for example, is even cheaper. But when you look at markets like the Euro area and Japan, you're talking about only 4 to 5% annual return from those markets.
Garry, when you cast this out further over the next decade, what have you come up with just in terms of a global portfolio?
Yeah, so those are the decade-long forecasts. I'm not saying that's going to happen next year. I mean,
Okay.
One of the key things about our report is that valuation is really important when you look at the 10-year time horizon. But we always like to say at BCA Research that it's not a good timing tool. And I put an interesting chart in this report that shows you that the correlation between the valuation and the 1-year return from stock markets is close to zero. It doesn't tell you anything at all. But when you look at the 10-year return, which is, as I said, very important if you're a super fund or a long-term investor, the valuation at the starting point explains about 80% of the returns you're going to get. So that's very important. If you think about the next 12 months, much more important are, will we have a recession? What are central banks going to do? Is inflation going to come down? Companies' earnings going to start to disappoint? That's what drives on the 1 year time horizon. Valuation is what works on the long run.
Have you adjusted your outlook then for the next 12 months, given where inflation is travelling at the moment? Obviously, we're sort of seeing elements of disinflation there, and perhaps that most central banks are now at the end of their tightening cycle.
Yeah, so for the next 12 months, we are pretty cautious. And eventually, we think the current episode is going to end in recession. And the debate, I think, has moved away from inflation. As you say, that's not the big issue. It's mostly coming down. But it's not coming down quite fast enough for central banks to be able to start to cut rates, I think. And in the meantime, the cumulative effect of the tightening monetary policy that we've had over the past year or two will start to work eventually. And it's worth remembering that monetary policy works only with long and variable lags, as Milton Friedman first said. And if you look at it on average, the recession in the US doesn't begin on average until 2.5 years after the Fed's first rate hike. So the first one was March last year. We're talking, maybe mid next year, maybe 1 year on average after the Fed takes rates above the neutral level. Now, you can debate what that is. We think that happened in about December last year. So that's pointing to the US recession beginning somewhere between the end of this year and mid next year. It hasn't happened yet, but I think the first signs of that slowdown are coming through. And inflation will come down. When growth slows, inflation will come down further. That's not the key problem at the moment. I think the key problem is going to be that we're likely to be facing recession in the next 12 months.
Yet, Gary, we're already seeing those recessionary conditions emerge, certainly in Europe. So what's your outlook there?
Yeah, I mean, Europe and indeed China look a lot worse than the US. The US economy has been somewhat resilient for a couple of reasons. One is that mortgages, unlike in Australia, where everyone has a floating rate mortgage, in the US, they are 30-year fixed rate. So you're not really impacted very quickly by changes in interest rates. Also, the US did a massive amount of fiscal stimulus during the pandemic, and that accumulated savings is still being spent. But we look at Europe, it's a much more manufacturing-driven economy, much more cyclical. It's clearly in slowdown. And that was driven initially by manufacturing, but we're now starting to see services slowing down in Europe as well. Europe also, like Australia, is very driven by China. And the Chinese authorities seem to be very reluctant to do any stimulus. Growth has been disappointing. Last quarter was only 3.5% GDP growth, quarter on quarter annualized. The government looks like it's missing its target of 5% this year. And that's obviously quite negative for commodity prices. It's a negative for emerging markets as well. So the US looks the most resilient. But even in the US, we don't see that lasting for more than, say, another couple of quarters.
So, Garry, just in terms of your projections for those returns, particularly as far as emerging markets, are you putting China in that bucket, or is this separate? What are your forecasts then for China, given what's going on there right now?
Yeah, I think the key for China is that growth in the next 10 years is going to be quite disappointing to what we've seen in the past 10 years. So a simple way that I use in this report for trying to calculate sustainable underlying GDP growth is simply the growth of the working age population, which in China is now shrinking because of the one-child policy, about 0.5% a year, and productivity growth, which in China is only about 1.5%. So you put those two together, and how is China going to create more than about 1 or 2% GDP growth? So there are other risks in China as well, but it comes out of this as not looking particularly attractive. The only way that it would, and this applies for emerging markets as a whole, is if you were to start to see some market-friendly structural reforms, governments in emerging markets allowing more private sector participation in the economy, changes in the labor market. We're seeing exactly the opposite happening in China at the moment. So to me, it's a market to avoid. I would even go as far as to say that the Chinese stocks are uninvestable at the moment.
Garry, you've covered off there on fixed income equities. What role do alternatives play here?
Yeah, they still look a little bit better, to be honest. If we look at something like private equity, for example, we're projecting there something like 9.5% annual returns, which is, the 20-year average is 15%. So it's lower than that, but it's a significant premium over public equities. The same would be true for example, hedge funds. I mean, not as good as that, but projecting their 8% returns. So on average, I think that that does make a lot of sense to be in those illiquid asset classes. You should be getting a premium from taking that illiquidity risk. But the only thing you have to be very clear is that you are in an illiquid asset class. So for many investors, that will not be appropriate. Your money is tied up in hedge funds or private equity for 5, even 10 years. So that is not appropriate for certainly most individual investors. And even for institutional investors, you've got to understand that that is the trade-off for getting that premium return. But overall, I think the trend that we've seen with superannuation funds, et cetera, moving more and more into private markets and alternative assets, that makes sense. And I think we'll continue to see that further.
Interesting too, you say that trade-off, that certainly applies. When you're looking at that decade ahead then, Garry, you're saying that investors either need to lower their return expectations or take more risk.
Yeah, so if we look around the world, I mean, typically US pension funds are still assuming 7% return. In Australia, for example, it tends to be sort of inflation or cash plus 3 or 4%, which today is coming to about the same. My projections are for a balanced portfolio, sort of 5% return. Where's the 7 going to come from? Either you have to be more realistic and say, we can't expect 7% nominal returns. We've got to lower our sights, or you have to take more risk. You can always get better returns, but by taking more risk, you're going to have bigger drawdowns during recessions, etc. That's the trade-off that you have to think through. And it's very much up to each individual investor to understand their return requirements and their appetite for taking risk, their ability to live through deep drawdowns when the economy turns down.
Garry Evans, Chief Global Asset Allocation Strategist at BCA Research. All right, that is the global view. Just before we go, a check of where we're likely to get going. Fairly flat opening. We did see US markets move higher. So SPI futures there just up some 4 points. Stay with us. The open is just around the corner.